our view is if the dollar continues lower and rates go lower, financial conditions are easing, and that gives a 9-month lead. So it might push it out further than we expect. We don't know yet, but definitely doesn't feel like the end of the cycle is going to be this year by any stretch.
Yeah, every cycle is different but the same, and it just feels like the scar tissue from the last cycle, which we all felt, is manifesting in a lot of the commentary that's coming through at the moment.
Raoul Pal and Jamie Coates believe the crypto cycle isn't finished but shifting into a new phase. Bitcoin dominance is starting to fall, liquidity is rising, and strong altcoins are showing momentum, suggesting the market still has room to run. Unlike the hype-driven rally of 2021, this cycle appears more mature, supported by fundamentals, utility, and solid tokenomics. Their models even suggest Bitcoin could still reach 6 figures as structural forces keep driving growth. They also see altcoins with real revenues and strong protocols benefiting as capital rotates, with the cycle possibly stretching into 2026. The message is clear. The peak hasn't arrived yet.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
Thanks for the support and enjoy the video.
I think just top level, everybody always wants reassurances. Is it over yet? Are we all doomed? What's going to happen? Have I got the wrong tokens? There's so much fear in the space, and there's a lot of hand-holding needs to be done. So I guess we start at top level of, where the hell are we?
Yeah, well, I mean, let's talk about, market psychology. I think, every cycle is different but the same, and it just feels like the scar tissue from the last cycle, which we all felt, is manifesting in a lot of the commentary that's coming through at the moment. Right?
Yeah, agree.
Now, it's a 4-year cycle. This is when it has to end. Therefore, it will, last cycle, it was to the moon forever because no one is keeping an eye on, or no one really, there were people such as yourself who were really getting a good handle on it. And it was really in early.
No, even I failed in the last cycle because I thought there was another leg to go. So,
yeah. So then everyone's sort of, I guess, truncated this cycle, and for good reason. It's not without, that there are frameworks out there that are credible, that should say that, this is, a time when things start to get, peakish. But we haven't had the typical business cycle, and not many people do that business cycle analysis that you and Julian do. So that framework that underpins everything at Real Vision and GMI, is sorely missed elsewhere. But it just feels that, it's a mechanical response to the market, that this is now when we should be peaking. And it's been, interesting to see the commentary flying on Twitter and everyone else. And even within our membership here about, is the top in. So, I'm always fascinated by market psychology and how it manifests in the market. I also think what's quite interesting is that everyone is very attuned to the liquidity cycle aspect now, and how that is going to change the outcomes in the future, as much as we think that, we've still got more to go. And all those things are they're the unknowns, but the framework that, we have here is very, I think, very clear that we have got more to go. I've got we've talked about my Bitcoin cycle risk framework and the topping indicators that I've been building. I mean, they're not screaming at me euphoria. There is definitely, and I highlighted this in that last report, Raoul, trend exhaustion signals in the Bitcoin chart and fundamental deterioration as well. But I think that's a function more of the transition into higher beta crypto through ETH primarily.
So the falling of Bitcoin dominance, which is typical of this point in the cycle anyway, right?
Yes. Yeah. And that transition really started, second quarter, but it was very clear by sort of July when I was on paternity leave, that transition had occurred, because I looked at the on-chain data on Bitcoin, the ETF flows between Bitcoin and Ethereum, and obviously the price action. And it very much lines up with, that transition period in the crypto market from Bitcoin dominance to high quality alts, not, a dash for trash sort of market that we saw in 2021 when people were getting stimulus checks. but a high quality alt season run at the moment. So that's kind of where I'm at.
And when we talk about the high quality alt season, I want to see where your head's at. My head's at is quality layer ones, revenue generating projects, and a few big things that capture attention, whatever they may be, that don't come with revenues or anything else, but they capture attention. We're seeing, Hyperliquid's obviously one of them, maybe Athena's another. We're seeing obviously Sui, Solana. How are you thinking this next phase is, and what are the types of tokens that participate?
Yeah, I like the way that you've just distilled that down into a very clear sort of representation of what really matters. Cash flows, are there protocols that are fundamentally strong, meaning that they have cash flows, they have usage, they deliver utility, and have very strong tokenomics. And there are a handful of those, and they are being rewarded by the market as they should. I've always had this view that as the asset class grows and as the, for lack of a better term, sophistication of the marginal new investor comes in, that they're going to look at fundamentals more and more. It's always been my base case. And I think that's playing out. I mean, you mentioned Hyperliquid generating a huge amount, generating the sort of cash flow or revenues that would make a, NASDAQ 100 company sort of water, like in terms of just the growth. In terms of like the multiples, I know we're not talking like for like, but in the case of Hyperliquid, it's trading on a revenue multiple that would put it, in the median of a tech stock in the S&P. But it is those high quality, tokens, L1s and the DeFi protocols. And yeah, the things that will grab attention because, that is not going away. Memes are definitely not going away. In fact, I'm starting to entertain maybe my first, meme position, which we can talk about later. Because
by the way, the Doge, ETF launches tomorrow. So by the time this is out, it'll have launched, which is interesting.
I was going to put it in my, that was one I was going to put it in my note. So yeah, no, I think it's a much more discerning market, and you're not seeing the broad-based rally. I mean, we're still, I think, early stages of this sort of broadening out or alt season, for lack of a better term. But it is going to be a very discerning type rally until we get to the end, when there will be short-term pumps and small caps, real small caps with, no product market fit that will start running. And that is on my, that's on my checklist for a market peak. And we're not there yet.
Raoul Pal and Jamie Coates argue the crypto cycle is far from over, pointing to falling Bitcoin dominance, rising liquidity, and growing strength in quality altcoins. Unlike the hype-driven rally of 2021, they see this cycle as more mature, fueled by fundamentals, utility, and strong tokenomics. Their outlook still includes the possibility of six-figure Bitcoin as structural forces continue to support growth. They believe capital will increasingly rotate into altcoins with real revenues, strong protocols, and even memecoins, keeping the cycle alive and possibly extending into 2026. In their view, what looks like a peak is actually a broadening phase of opportunity across the crypto market.
Let's get back to the video.
Where is your measures? Because you look at liquidity too, and you've been posting some stuff on X about it. Give us your top down where we are on the liquidity cycle from your perspective.
So I think April for me was the demarcation of an important inflection in liquidity, because I have my own global liquidity index, as do you, and they're all sort of like proxies for kind of what we think global liquidity is, and they differ a little bit. But once you regress these things, they have a very strong correlation. And if you do sort of like predictive measures like Granger, causality, and whatever, yes, it does have very significant predictive value. So I do use it a lot, but I also, appreciate that it's not a perfect one-for-one for global liquidity.
No, and people get confused over that. It's a roadmap. It's the contextualization of where we are in the cycle and what to kind of expect, as opposed to, oh, well, it went up today, so in a month's time it'll go up. It's like, it doesn't work that way.
Yeah, exactly. It's going to wiggle. It's going to, it's going to surprise a little bit. But like from my first principles basis, global liquidity goes up. That increases the marginal demand for risk assets. And the preference for risk asset investors is the assets that give the most protection to monetary debasement, which is why they've got marginal new dollars coming into the financial system to buy assets in the first place. So, but that sort of what I call like a super bullish regime, which is just like using technical analysis on global liquidity, looking at the breakout that happened in April, gives us runway for another, typically though these periods of like the breakouts last for about 2 years based on previous cycles. But this is the ascent of global liquidity this cycle is far more moderate for reasons we can get into. But like, I think that, and also let me just, also add that global liquidity increasing is not, or the absolute level of global liquidity is not the most important metric. It's the rate of change, and risk assets will sniff that slowing down. So I think there's another sort of 6 months left in the cycle. And I know that's pretty much lining up with where you are as well. Maybe it's a little bit more, maybe it's a little bit less.
Well, our view is if the dollar continues lower and rates go lower, financial conditions are easing, and that gives a 9-month lead. So it might push it out further than we expect. We don't know yet, but definitely doesn't feel like the end of the cycle is going to be this year by any stretch.
Well, yeah. And so, well, that actually, that correlates to what I see on the chart here, because we've just broken above. Like, it's been sort of 5 months where we're in this sort of new regime where global liquidity is higher than where it was at the peak of the last cycle. And that usually, and, I've got another chart here which looks at sort of liquidity versus debt, which I think is the critical metric. And the problem is that debt has been growing at a clip. Like, I think since 2023, when I ran the numbers, US public debt has risen by about 15%. GDP has gone up by 10%. So there's a 5% differential there that is a problem. The bigger problem is that the liquidity growth is around 3 or 4% since then. So there's almost like
I've been trying to think this. I've been trying to think this through, Jamie, from, you and I swapped that chart where you sent it over to me and said, what do you think? And I'm like, yeah, okay. And I've been thinking, my fear is we're not measuring part of global liquidity. And that's the duration of issuance, right? The bills, I don't think is getting captured by any of our work. Somebody else on Twitter posted something about it today that they're working on it. And I fear that somehow we're missing yet another liquidity lever that we didn't know was coming, which was like, we're not going to issue at 5 years anymore. We're just going to issue in the first 3 to 6 months. And that's more, and Mike Howe was on the podcast today, and it was like, that seems to be more liquidity that maybe you're not capturing in this.
I would be the first to admit that. In fact, when I put this on Twitter, that's exactly what I said like a week or two ago when I put it up. I said, I'm not capturing this, I guess, this new form of liquidity that's coming, directly from the Treasury rather than through the central banks or the monetary based metrics that make up my liquidity measures. So I would definitely agree with that.
Could we measure it as a proxy using the rate of change of money market funds? Something, because these get issued somewhere, right? They either get issued into stable coins or generally issued into the banks or into money market funds or some combination. I wonder if there's an easy proxy, or do you have to go through and clean the data and do all of the laborious work of figuring out exactly what was issued and where in the curve?
I thought about stable coins and using that as trying to blend that in as a way to capture what the Treasury is doing, but I hadn't really thought it through.
It's just interesting. It's been in the back of my mind. Like, we haven't got, it's not complete yet.
Yeah. And it feels like this is the conversation we're having in like mid 2022 when we were like building stuff and we were having these conversations and we kind of came to the same conclusion about like where the bottom was going to form. But I haven't done the work. And I'm sure you guys will, as will I, but I think it's definitely missing because obviously that's since Yellen, that has been the playbook. The quantitative, the balance sheet's been tightening for the last 3 years, but Bitcoin is up. And that's because liquidity is being pumped in through other mechanisms.
And that's why we've been using the total liquidity as opposed to Fed net liquidity. And before that, the balance sheet. Here's another interesting thing that we found in GMI. We're like, why is this business cycle longer? Part of it is like rates haven't come down. Okay, fine. Then we went back and did the foundational work again about debt maturity. And what we found is back in 2021, they lengthened the maturity of the debt because they could, because rates were low.
Yeah.
And so now, 5 years later, we're having to roll that debt. And it's because it was 5 years and not 4 years after the 2021 cycle. They extended the cycle by a year because they extended duration. Now what they're doing is, looks like they're shortening cycle. And so it might bring the cycle back again. Or if they continue to just issue in the short end, maybe we don't get a cycle. I'm not suggesting that's the case, but just intellectually, it's interesting to see, oh, and if they just continue to issue the short end, there is no cycle because it's just endless liquidity.
Yeah, so I would love to see the work on the composition of debt based on maturity. It's not that there's endless liquidity. It's that the system is way more fragile in that environment, right? Because they have to be, it's like they have to constantly be on the case in managing the financial system and, you know, making sure that volatility in the bond market doesn't start creeping. Because like with the previous regime of more long dated issuance, there was these cycles of like 4 to 5 years, and, you know, they became, I think, a lot more sensitized to it and able to get ahead of it. Now they've just basically turned into a short-term, you know, a short-term liquidity engine, which I think causes a whole bunch of other problems.
It's like basically buying a car on a credit card.
Yeah.
As opposed to, you know, a 5-year car loan.
Right. Which could accelerate the exiting of, from US treasuries in one aspect, but maybe stablecoins sort of plug the hole. I don't know. It's incredibly interesting, but obviously there's just more liquidity, more cowbell.
Raoul Pal and Jamie Coates conclude that the crypto market still has significant upside ahead. They point to falling Bitcoin dominance, rising global liquidity, and the growing strength of altcoins as signs that this cycle is far from over. Unlike 2021's hype-driven rally, today's growth is anchored in stronger fundamentals, real-world utility, and sustainable tokenomics, which could still push Bitcoin towards six-figure levels. They believe the next phase will be defined by capital rotation into quality altcoins, protocols with real revenues, and even memecoins, with the potential for this cycle to stretch into 2026. Rather than marking the end, current conditions suggest a broadening and maturing market that continues to create opportunities for investors. Do you think Bitcoin will hit six figures before this cycle ends? Which sector do you see leading the next wave, Bitcoin, Ethereum, or altcoins? Let us know in the comments.